There are moments in investing when a single business deal tells you much more about the market than the deal itself. And I think the announcement involving Goldman Sachs and NEOS is one of those moments. At first glance, you might look at the headline and think, okay, Goldman Sachs is acquiring NEOS. What does that really mean for me if I already own SPYI or QQQI? That's a fair question, but I believe the more interesting question is not simply what happens to one ETF. The bigger question is this: why would one of the most recognizable names in American finance want to bring NEOS into its business in the first place? Because when a company like Goldman Sachs makes a move like this, I pay attention. Not because Goldman Sachs is always right, no financial institution is. I pay attention because large financial institutions tend to move when they see a structural change happening in the market. And the structural change here is the growing demand for income. For decades, investors had a relatively simple menu when they wanted income. You could own bonds, you could buy dividend-paying stocks, you could build a portfolio of blue-chip companies and collect dividends over time. But the investing world has changed. Today, more investors are asking a different question. Instead of simply asking, how much can my portfolio grow? They're asking, how much income can my portfolio generate while I'm still invested in the market? That distinction is incredibly important. Imagine someone in their 60s who has spent 30 or 40 years building a retirement portfolio. They may have $500,000, $1 million, or even more invested in stocks. At that point in life, the goal may no longer be to maximize every possible dollar of growth. The goal may be to turn part of that wealth into something usable: monthly bills, healthcare costs, travel, helping children or grandchildren, or simply having the confidence of knowing that some money is arriving in the account without having to sell shares every time cash is needed. This is where covered call ETFs have become so interesting. Instead of relying entirely on traditional dividends, these funds can use options to generate premiums from an underlying portfolio. In simple terms, they are trying to turn some of the market's volatility into cash flow. Of course, that doesn't mean free money. There is always a trade-off. A strategy that generates more income can potentially sacrifice some upside during strong bull markets. And a high distribution rate does not automatically mean a high total return. That is one of the most important lessons investors need to understand. You should never look at a 10%, 15%, or 20% distribution rate and immediately assume that you are earning 10%, 15%, or 20% in real wealth every year. Income is only one piece of the puzzle. Total return matters, risk matters, capital appreciation matters, and perhaps most importantly, the sustainability of that income matters. That is why I find the Goldman Sachs and NEOS deal so fascinating. This does not appear to be a story about Goldman Sachs simply wanting one popular Bitcoin covered call ETF. According to NEOS, Goldman Sachs was looking at the entire platform: the equity income products, the hedged strategies, the alternative income products, the Bitcoin and Ethereum strategies, the real estate exposure, and perhaps most importantly, the team that built these products. That tells us something. Goldman Sachs appears to see option-based income not as a temporary trend, but as an increasingly important part of the investment landscape. And if that view is correct, we may be watching something much bigger than one acquisition. We may be watching the gradual transformation of how millions of investors think about income. Think about what happened with index investing. At one time, the idea of simply owning an index through an ETF seemed revolutionary. Then ETFs became mainstream. Something similar may be happening with income strategies. Covered calls used to be something many individual investors never touched. They were complicated. They required options knowledge. They seemed like a tool reserved for sophisticated traders. Now investors can access these strategies through a single ETF, and that changes the conversation. You no longer need to personally sell calls against every position in your portfolio. You can choose a professionally managed strategy and let the fund handle the mechanics. But here's where I want you to slow down for a moment. The real story isn't that Goldman Sachs bought NEOS. The real story is what Goldman Sachs may be saying about the future of income investing by choosing to buy NEOS. Because when one of the largest financial institutions in the world decides that an established option income platform is worth owning, it sends a signal. It says the demand for portfolio income is real. It says investors are searching for alternatives. And it suggests that the competition between traditional dividend strategies, covered call ETFs, leveraged income products, hedge strategies, and other forms of portfolio cash flow may become even more intense. And that brings us to the question that matters most for investors already holding NEOS ETFs. Should you be worried? Or could this actually be the beginning of a much bigger opportunity? Let's take a closer look. Now let's move past the headline and look at what this actually means for investors. Because when you hear the words Goldman Sachs is acquiring NEOS, it's very easy to imagine that everything is about to change. New management, new tickers, new investment strategies, maybe even a completely different ETF. But based on what NEOS has explained, that is not the plan. The existing NEOS team is expected to remain in place. The people who have been building and managing these strategies are not simply disappearing overnight. The tickers are expected to remain the same, and the NEOS brand is expected to continue. For an investor holding a NEOS ETF, that distinction matters. Imagine that you own a small local restaurant that suddenly becomes part of a much larger hospitality company. The kitchen may still have the same chef. The recipes may still be the same. The people you recognize may still be there. But now the restaurant has access to a much larger purchasing network, marketing department, technology system, and distribution network. That is essentially the opportunity NEOS sees in this transaction. NEOS has already grown substantially, but being a smaller asset manager comes with limitations. There are platforms where your products may not be available. There are financial advisors who may not know your company. There are investors who may never have heard of your ETFs. And in finance, distribution matters. You can create a fantastic investment product, but if investors and advisors cannot access it, the product has a ceiling. This is where Goldman Sachs could potentially change the equation. Goldman Sachs has an enormous global presence, established relationships with financial institutions, advisors, and investors, an infrastructure that would be difficult for a smaller firm to build on its own. So the acquisition may give NEOS something that money alone cannot easily buy: reach. And reach can become growth. Think about the difference between having a great restaurant on a quiet street and having that same restaurant placed inside an international hotel chain. The food may not change, but suddenly millions more people have a chance to discover it. That is potentially what Goldman Sachs brings to NEOS. And there is another part of this story that I think investors should pay attention to. Goldman Sachs and NEOS already operate products that can look similar from the outside. For example, there are different ETFs designed around the S&P 500 and NASDAQ 100 with different approaches to generating income through options. So naturally, you might ask, why would Goldman Sachs want competing products under the same umbrella? Wouldn't it make more sense to merge them? According to NEOS, that's not necessarily the plan. And honestly, I think that makes sense because investors are not all looking for the same thing. One investor might want a more conservative approach with greater emphasis on total return. Another investor might prioritize current distributions. Another might want a leveraged strategy. Someone else might want downside protection or hedging. These are different problems, and different problems require different tools. Think about a toolbox. You don't say, I already have a screwdriver, so I don't need a wrench. You keep both because they solve different problems. The same philosophy can apply to ETFs. A higher distribution strategy isn't automatically better than a lower distribution strategy. A leveraged ETF isn't automatically better than an unleveraged one. And a hedged ETF isn't automatically better than an unhedged ETF. The right question is, what problem are you trying to solve? That is the question I would encourage investors to ask before buying any income ETF. If your primary goal is current cash flow, you may evaluate one product differently than someone whose priority is long-term capital appreciation. And if you're retired, your priorities may be different again. This is why I think the growing number of covered call ETFs is both exciting and dangerous. It's exciting because investors have more choices than ever, but it's dangerous because more choices can create the illusion that the highest yield is the best choice. And it isn't. Let's say two ETFs both advertise attractive distribution rates. One produces a large amount of cash flow but consistently gives up significant upside. The other distributes less but preserves more exposure to long-term market growth. Which one is better? There is no universal answer. It depends on the investor. This is where the concept of total return becomes incredibly important. Imagine you invest $100,000. One fund gives you $15,000 in distributions during the year, but the underlying investment falls significantly. Another fund gives you $8,000 in distributions, but the asset value rises enough that your total wealth increases more. If you only look at the distribution, you might choose the first fund. If you look at the entire picture, the answer could be very different. This is why sophisticated income investors don't simply ask, how much does it pay? They ask, where does the income come from? What is happening to the underlying asset? How much upside am I giving away? What happens during a strong bull market? What happens during a prolonged bear market? And most importantly, what does my total return look like over a full market cycle? Those questions become even more important as covered call ETFs become mainstream. And this is where I think the Goldman Sachs NEOS combination could become particularly interesting. NEOS isn't simply bringing a few ETFs into Goldman Sachs. It is bringing an established team and a platform built around option income strategies. Goldman Sachs, meanwhile, brings scale. Put those two things together, and you potentially have something much larger. You have product expertise combined with distribution power. You have an established brand combined with a rapidly growing category. And you have the possibility of introducing even more products to investors who are actively searching for income. NEOS has also indicated that it has additional products in registration and more ideas under development. That means this acquisition may not be about the ETF lineup we see today. It may be about the ETF lineup we see 3, 5, or 10 years from now. And that is a very different way to look at the deal. Because the financial markets are constantly evolving, 20 years ago, many investors wouldn't have imagined building a retirement income strategy around ETFs that actively use options every week. Today, it's becoming increasingly common. The next evolution could be even more sophisticated. We could see more targeted income strategies, more combinations of equity exposure and options, more alternative assets, more hedging, more products designed around specific retirement needs, and potentially more competition among major financial institutions to capture this growing demand. That competition could ultimately benefit investors. Why? Because competition forces asset managers to improve. Lower costs, better product design, more transparency, more choices, better distribution. But competition also means investors have to become more educated. And that may be the most important message in this entire story. Don't let the Goldman Sachs name make you assume that every product under the umbrella is automatically a great investment. And don't let a double-digit yield convince you that you've discovered a financial shortcut. There are no shortcuts in investing. There are only trade-offs. Higher income may come with reduced upside. Leverage may amplify both gains and losses. Options can generate premiums, but they don't eliminate market risk. And a distribution is not the same thing as a guaranteed return. The smartest investors understand those trade-offs before they invest. So when I look at this transaction, I don't see Goldman Sachs simply buying another ETF company. I see a large financial institution positioning itself more aggressively in the future of income investing. And I see NEOS gaining access to resources that could potentially take the company to another level. NEOS has talked about growing from more than $30 billion in assets toward $100 billion and beyond. That's an ambitious goal. But with Goldman Sachs behind the platform, the path to that goal could look very different. Of course, none of this guarantees that NEOS products will outperform. It doesn't guarantee higher distributions. And it certainly doesn't eliminate risk. What it does is create a new possibility, a possibility that NEOS can reach more investors, launch more products, expand internationally, and compete on a much larger stage. And for investors who depend on portfolio income, that could be worth watching very closely. Because sometimes the most important change in investing isn't the change you see in your brokerage account today. It's the change in the infrastructure behind the products you may be holding for the next 10 or 20 years. So after looking at everything we've discussed, what should investors actually take away from the Goldman Sachs and NEOS deal? For me, the biggest lesson is not about one ticker. It's not about whether SPYI is better than another covered call ETF. It's not even about whether Goldman Sachs got a good deal. The bigger story is that the world of income investing is changing. For generations, investors were taught a fairly simple formula. Work hard, save money, build a portfolio, buy dividend-paying stocks. and eventually live off the dividends. There is nothing wrong with that philosophy. But the financial markets have evolved. Today, investors have access to strategies that previous generations simply didn't have at the same scale. Covered calls, option income ETFs, hedged equity strategies, leveraged income products, alternative assets, Bitcoin and Ethereum strategies, and increasingly sophisticated ways to turn a portfolio into a potential source of cash flow. But with greater choice comes greater responsibility. Because the moment you start seeing an ETF advertising a very high distribution rate, you have to resist the temptation to think, that's the one I want. Instead, take a step back. Ask yourself what you're actually trying to accomplish. Are you trying to maximize monthly income? Are you trying to preserve your capital? Are you trying to grow your portfolio over the next 20 years? Are you retired and need predictable cash flow? Or are you still working and simply want to reinvest the distributions? Those are completely different objectives, and the same ETF may be excellent for one investor and completely inappropriate for another. That's why I believe the Goldman Sachs acquisition of NEOS is important. Not because it suddenly makes NEOS ETFs risk-free. It doesn't. Not because Goldman Sachs can guarantee better returns. It can't. And certainly not because a high distribution rate suddenly becomes safer simply because Goldman Sachs is involved. Instead, the significance is that one of the largest names in global finance is putting more resources behind a category that millions of income-focused investors are already watching. That tells us something about where the industry may be heading. Goldman Sachs appears to believe that demand for portfolio income is going to remain important. And I think that makes sense. Look at the demographics of America. Millions of Americans are moving into retirement. Many are living longer. Many are worried about inflation. Many don't want to sell large portions of their portfolio every month just to pay their expenses. And many are searching for ways to make their investment portfolios do more than simply sit there and appreciate in value. They want their money to work. They want their portfolio to produce something they can actually use. That is the fundamental appeal of income investing. And covered call ETFs are one response to that demand. But here's the philosophical part that I think gets lost in all the discussions about yield. The purpose of investing isn't to collect the highest possible distribution. The purpose of investing is to build a financial life that supports the life you actually want to live. Those are two very different things. If an investor spends all of their time chasing the highest yield, they may eventually discover that they were optimizing the wrong number. Maybe the portfolio produced more cash, but perhaps it sacrificed too much growth. Maybe the distributions looked impressive, but the underlying asset declined. Maybe the investor received a large amount of income while quietly losing purchasing power. That's why I always come back to one simple idea. Don't invest for the number, invest for the outcome. And this is where I think the Goldman Sachs NEOS combination could become particularly interesting over the next several years. NEOS brings experience in designing option income strategies. Goldman Sachs brings scale, infrastructure, distribution, and a global network. Together, they may be able to bring these strategies to investors who have never even heard of NEOS. And that could potentially push the entire covered call ETF industry forward. Other firms will compete. New ETFs will appear. Existing ETFs may evolve. Fees could become more competitive. Strategies may become more sophisticated. And investors will have more choices than ever before. But that last point comes with a warning. More choices don't necessarily make investing easier. Sometimes they make it harder. When you have 10 ETFs, choosing can be simple. When you have 100 ETFs offering different yields, different option strategies, different leverage levels, and different underlying assets, the responsibility shifts back to the investor. You have to understand what you own. You have to understand why you own it. And you have to know what could go wrong. So if you currently own a NEOS ETF, I don't think the headline alone should cause you to panic. The transaction has its own approval process, and investors should pay attention to the official communications and proxy materials when they become available. But there is also no reason to assume that the Goldman Sachs name automatically makes every NEOS product a better investment. Do your homework. Look at the strategy. Look at the underlying assets. Look at historical total returns. Look at distributions. Look at volatility. Understand the option strategy. And think about how the ETF fits into your overall portfolio. Because at the end of the day, that's what investing is really about. It's not about finding the perfect ETF. It's about building a system that can survive different markets and different stages of your life. Bull markets, bear markets, high inflation, low inflation, periods of excitement, periods of fear, and eventually the transition from earning a paycheck to living from the wealth you've accumulated. Maybe that's the most important thing to remember when you look at the Goldman Sachs acquisition of NEOS. This isn't simply a story about a financial company buying another financial company. It's a signal that the definition of income investing is evolving. And if you're an investor who cares about passive income, retirement cash flow, or simply making your portfolio more productive, this is a trend worth watching. Because 5 or 10 years from now, we may look back at this moment and realize that it was part of a much bigger transition in the way Americans generate income from their investments. But remember, the goal isn't to chase the biggest yield. The goal is to build sustainable wealth. The goal is to create income without losing sight of growth. The goal is to make your portfolio serve your life, not to spend your life serving your portfolio. And perhaps that's the real opportunity investors should be thinking about. Not simply, how much will this ETF pay me next month? But what kind of financial freedom can this portfolio help me build over the next 20 years? That is the question that matters, and that is the question I would keep in mind as the Goldman Sachs and NEOS story continues to develop. Thanks for watching. If you found this analysis useful, make sure to like the video and subscribe to the channel. And let me know in the comments. Do you think Goldman Sachs acquiring NEOS is a major positive for SPYI, QQQI, and income investors? Or do you think investors should remain cautious? I genuinely like to hear your perspective.